tax laws are changing and not for the good. Join us as we look at the impact of significant increases on capital gains. Well, thank you for joining us today. It is now after tax season, and we are, this is with Jeff Wood here, myself, John Sluice. Definitely a little bit more relaxed and enjoying the sunshine here. I'm excited to come to you to talk a little bit more about tax planning. And it seems like we're doing and talking about this sooner than we ever have before.
Right. But as we mentioned before, we do conduct some planning throughout tax season because the numbers are in front of us and we need to set up quarterly tax payments. But with the current administration, it's really ramping up these sorts of conversations.
So this is video number 2 of a series that we're pulling together, just addressing the idea that more and more individuals are coming to the realization and the understanding that tax rates are likely going to go up. We don't know where, we don't know how exactly. A lot of this is proposed. So what we're talking about today is many parts of it are proposed. But what we're seeing is a shift of the likelihood of income or tax brackets going up. And so how do we plan for that? What do we be doing now? What should we be doing now? It's, you know, we're sitting here coming to you in June, and it is typically sooner than we would normally be thinking about some of these. But these are major moves and major things that we're talking about. We're going to be talking about selling businesses, selling pieces of property, selling otherwise, that you can't just all of a sudden, you know, turn the light switch and it moves. So we want to be having you think about some ramifications of this and otherwise. So.
And today's topic is going to focus on capital gains in particular. And this is a great time of year where some of our business clients are looking to make moves, to buy, to sell. So in particular on the sell side is what's going to trigger a gain.
Yeah. And as I look back, I mean, one of the earth-shattering or tax-shattering things about what we're going to talk about today is the idea that it throws me off that we were even thinking about this or talking about this, but on the docket or on the proposals are the idea of taxing capital gains at ordinary rates. That is just crazy. It's just a change in mentality, a change in idea of what that is. And I know we'll explain what ordinary versus capital gains are and what you know, the different types of tax things that we're going to be talking about here. But fundamentally what we're talking about is a shift of taxing current income and starting to tax those that inherently are building wealth. So one of the core tenets of the current tax law that are out there that says if you don't have a taxable transaction, or if you're continually to grow and have these assets or these items here that you have not sold or you have otherwise are still growing and still utilizing, typically the idea is that you don't pay tax on it. You wait until later. And what they're talking about right now is starting the idea of taxing these earlier, sooner, and at a much higher rate. And that's what scares myself and you, and as we talk about the whole tax economy, if you will, or the tax professional, the world there, is that it's so fundamentally different in the change of the idea that it's shifting away from rewarding those that save to rewarding those that don't save. And that just, it blows your mind a little bit when you think about it.
And you mentioned the rate going up. In effect, it's doubling.
Yeah, so the current proposal out there is, and again, this is just proposed, is that any capital gains that you have, if you're making more than $1 million, would be taxed at your ordinary rate. Well, so maybe as I step back a little bit, what is that? I said a couple things. What does that mean? So currently, ordinary income. So think when we say ordinary, that's you working, that's you making active income. So as a job, as current dividends, otherwise those are all ordinary, potentially ordinary taxable income.
Even retirement earnings.
Yeah, even retirement earnings, it's ordinary. Versus capital gains is something that you buy and you hold for a long period of time. Stocks, properties, closely held corporations, some qualified dividends. That are in there. So it's the idea that you defer the benefits of something today and get it down the road. That's where capital gains comes in. And historically, that is taxed at a more favorable rate. So if, as an ordinary, if you're in the 32% bracket, you're going to be paying 15% capital gains. If you're in the 12% bracket, you're going to be paying 0% capital gains. So you generally have a tax favorable, and it rewards those that defer and wait to recognize their benefit. What they're proposing now is that if you make above $1 million, that you would then potentially have to pay ordinary rates. So as high potentially as 39.4% taxes on that capital gain. That's just mind-blowing. In what currently is 20% could be now currently 37 or 39.4 or 39.6, depends on.
And I don't believe that Medicare surtax is going away.
Right.
So almost another 4% tacked on.
Good example there. So let's hypothetically talk through this. I'll give you an example. If you had a piece of property that you purchased several years ago for $500,000 and you now sold for $2 million, so you have a $1.5 million gain. Currently, you would pay 20% federal capital gains on that. Under this new tax law, you would be paying potentially 39% tax law, so 40, almost double. It's just, it's earth-shattering on the implications of what this has. Now, I do want to say and use this opportunity, and we're going to talk about this in another video, on the idea that we have to be careful that we don't just jump off cliffs and we don't just, throw the baby out with the bathwater, the sky is falling, whatever analogy you want to say, that we don't just go too far. We still are accountants, and we do still like the idea of planning and not paying taxes sooner than you need to, and as you work through these. But you need to be aware that this has significant potential impact for major events and major transactions that you're going to have inside of your retirement and your overall wealth as an individual and as a family. So.
And another example that I see in our client base would be an older person who purchased some lakefront property decades ago, and by those standards, they bought it cheap. Or by today's money, they bought it cheap. And with the real estate market the way it is, it could be worth several $1 million or more. And they bought it for, I don't know, a couple $100,000 back then. So, a big part of this, the gain component of a capital gain, is just the cost of inflation as well, which it sort of interests me, something that doesn't really come up very often. But $1 30 years ago is like, say, $20 today. And you're being taxed on that. Yeah,
and with the potential inflation that everyone's talking about right now, that's only going to become more relevant, in individuals' faces. So.
My analysis is a little skewed there, but...
What you're referring there is, I do want to highlight too, is the way the media and the politicians are going to be presenting this, and we can argue whether this is right or wrong, is that it's a tax for the wealthy, it's a tax for the rich, and so don't worry. Again, we can argue whether that's good or bad, but that's how it's going to be presented. And when you look at that, it says, it only applies if you make more than $1 million. That's the wealthy. Don't worry about that. What I would pose here, let's go to the example where you just mentioned, is you had a cottage on the lake. That could be your mom and dad, your grandma and grandpa. It could be you, however you want to look at it. Maybe you're making $100,000 a year, 100, and so you wouldn't consider yourself wealthy, or 50 or whatever the number is, that year over year you're below that $1 million mark. But when you go to sell that one transaction, boom, you jump over the $1 million in gain, and then all of a sudden you're pushed into that bracket. That's what we see happening more and more as it relates to what's the risk that we're going to have to be working through and thinking through. Well, and that brings us full circle back to planning and looking ahead, that what we are observing is the new tax law is seeming to be taxing more on single events and transactions than it is overall. I mean, we are going to have those overall ones as well, but they're looking for opportunities where it hurts a little bit less to pay the tax. So whether we're talking the estate, whether we're talking the capital gains, we're talking some of these other ones where you are flush with cash because of a particular transaction, it hurts less to pay taxes right then. That's what they're leaning more towards, but you have to plan around it because that makes a big difference. Again, if you're saving and you're penny pinching as you work your way through and building your business, in those dollars, every dollar does count. If all of a sudden you double your taxes on what you're planning on, that has a major impact of what your overall portfolio is when you go to retire. $400,000, $500,000 in taxes. These are not small dollars that we're talking about here, and that you need to be aware and need to be thinking of.
So we pretty much set the stage for the types of events that could trigger this. And what is on everyone's mind, I'm sure, is how can we plan around that? What are some opportunities to even that tax rate out?
Well, the first one that I would be my go-to tool, if you will, would be what's called a 1031 exchange. And that's where you can then recognize potentially, you could have a sale, you could have a step up, if you will, and then or you just defer the gain. I use this as the first example here because that is one of our go-to tools
For real estate.
for real estate that they are looking at getting rid of. So here's just one more example that they're looking at taking away and increasing some of these taxes further. So what is our go-to tool today may not be available in even a couple months or who knows when. So.
In times past, we had like-kind exchanges for machinery and equipment, that sort of thing, to help defer taxes.
Yeah, and
that went away.
Yeah, they took that away this last round.
So there's some precedent on that benefit being removed ultimately. Installments, installment gain treatment. That's another tried and true method.
Now, and again, this is all preliminary and proposed and planned, and so we don't know whether the $1 million mark that they've thrown out is that married filing jointly, is that total income, is that the one capital gain income, what makes that up? We're going to make some assumption for purposes of discussion here, but what you're talking about an installment is you defer that gain or you spread that gain out over a couple years. Maybe it's 2 years. Maybe you do a closing, and instead of having the whole gain recognized on December 31st, you do December 31st and January 1st. You've now just split it between 2 years, and maybe you get below certain thresholds because of that. Or maybe you go even further. You go 5 years or 10 years. We always say, the more patient you can be, the more likely you're going to pay less taxes, right? That's the way the IRS is built. Again, that idea of those that are willing to wait are going to benefit. Again, that throws off the whole, we're even talking about this, is it's throwing it on the head. But that installment sale idea that you can defer that gain over time, and you're going to be then in a lower bracket, because instead of recognizing $1 million all at once, you might recognize $200,000 for the next 5 years, and you fall below certain thresholds.
And in this year of possible transition to a higher capital gains tax, when you make a sale of something that's eligible for installment, we have until the due date of the tax return to elect to not treat it as installment. So we could get it all taxed in 2021 if rates are still lower than what they will be.
That brings up a good example here that I'm going to use some real clients to talk through. So in 2020, they recognized some sales. So they sold some properties. And I, as the tax preparer, with the historical built-in bent that we've been told and ingrained in our world of saying you defer taxes as long as you possibly can, keep pushing it off, I looked at it and said, well, look, why don't we split these up? We can split it because actually some of the payment didn't happen until 2021. So I said, let's split it between 2 years. One part of it in 2020, in part in 2021. And we're going to get into the 15% capital gain. And I talked to the client. We went through it. We used this as highlighted the different things. Because if we do it all 1 year in 2020, they were in the 20% tax. So they bumped up. And I said, well, my normal tax bent said, well, why do that? Why pay that extra 5% when we can spread it over 2 years? And their opinion was, you know what, John? Right now it's 20%. We don't know what 2021 is going to look like. There's a good chance that 2021 is going to tax it at 40% tax versus the 20. And I'm going to look brilliant for taxing at 20%. Now, he doesn't know whether or not it's going to be 15 or 20, and whether he paid that extra 5% needlessly, because in hindsight, if this tax law does not pass and the capital gain would have stayed at 15%, he overpaid. But if it comes back and it says that he would have had to pay that 20%, he would be paying ordinary at 40% taxes, it's going to look brilliant. There's an instance where they made a conscious decision of a known cost, and they were comfortable paying the tax earlier at the 20% versus what could be the 40. That's not going to be the right answer for everybody, but it's what we're proposing, and it's what we're starting to have these discussions on with clients and individuals such as yourself that are looking at some of these transactions, because it's a known cost today versus an unknown could be significant impact to you.
And right now we're under the impression that this 1 million threshold is the ordinary income So if you have $1 million or more of ordinary income, that means any dollar over $1 million in capital gain will have a higher tax rate. So that opens up some more planning opportunities on how to keep your ordinary income lower in a year of sale. So if perhaps you're still working and you have a large bonus that you know you're eligible for, and you're right on that threshold, then if you can delay that bonus, that's something we would advise. So there's a strategy to defer taxation into a subsequent year because of this one-time event. It
is, yeah. There are strategies that we could be doing. We can planning whether it's in the year of having a sale or a transaction. You've got the contributions to charitable trusts or into donor advised funds or other things too that you can defer. Those are all strategies we can talk through. But to some extent too, those are only strategies that you can do so far. And again, I'll use the example, and I've been focusing on a $2 million, a $3 million sale. There are individuals that are selling for $15 million, $20 million on their sale. That's tough to spread $15 million or $20 million or $30 million over a long period of time because it just doesn't happen that way. And so whether or not you sell this year versus next year may have major implications. And surprisingly, you're going to be talking to more and more people that have this happen versus not. So 15 million seems like a very large number. 5 million seems a large number, and it is. But it's more often than you think. I mean, it happened because of inflation, because of other things that are in the market the way they are today. That's in play.
Well, something you're touching on is, as tax planners, we want to lower taxes or minimize taxes as much as possible. Our clients are paying us to do this. And there is a point where we can't go any further. You're just going to have to know that liability and plan for it.
And when you're looking at that liability of being 40% versus 20%, that makes a big difference. I ran some numbers earlier with another proposed sale, and it was interesting that it was better for them to sell this year at $3 million than wait 2 years at $5 million, because they would actually end up with a net better cash in their hand today than if under this new proposed law. So, I mean, it's significant. There are big dollars on the impact of ordinary versus capital gains. And so it is things that you need to be thinking about. And we've hit on the most likely one, which is a sale of a business or a closely held business, right? Or a property. We can run numbers. We can talk through those. We can plan through those. I always tell the business owners that you got to be looking at least 5 years out before you're selling. And you're thinking about that. That's fast now. If all of a sudden, if you're hearing this for the first time that says, ooh, if I have to sell my business, it's going to jump from 20% tax to 40% tax, and you want to start selling it and think about it now, you're already behind the game, because we should have been talking about this for 3 or 4 years in advance to even get to this point of being able to say, now we're ready to sell. So,
and we just don't have that kind of crystal ball usually. We're at the whim of politics is what it comes down to in this particular instance.
So as we wrap up here, we're going to have future videos on other items, particularly with estate tax and some ordinary, or some strategies that we can use if you're making above $400,000, and some ordinary taxes that are going to be we're working through. Today we are talking about capital gains. So what you need to hear from us through this video and through today is that there is on the proposal, on the docket, the idea of either eliminating or taxing at a higher rate capital gains. You need to be thinking about how that impacts you, what you need to be thinking about. It may be nothing, but you need to think about it. And it may be a very large thing, like the sale of your business or sale of your property or otherwise. So don't hear from us to say, go and fire sale everything you own. So don't do that. But do hear us that these are potentially real. These are significant ramifications that have a big impact on your overall wealth and financial stability as you start entering into retirement and in later years. Thank you for joining us. We look forward to talking to you in the future, and have a great weekend.